welcome to Shriram Properties Limited Q4 and FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Murali Malayan, Chairman and MD, Shriram Properties Limited. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, good morning to all of you. First and foremost, I would like to extend a warm welcome to our investors and analysts. This meeting gives us a valuable opportunity to discuss our operational and financial performance. The board has adopted Q4 and FY24 financials. I am pleased to report that this quarter has been exceptionally strong for the company. We have delivered outstanding operational and financial results. Before discussing the financial performance in detail, I would like to highlight key operational highlights during the year and for the quarter. During the quarter, we recorded sales of 1.56 million square feet and sales value of over 700 crores. More importantly, we have recorded highest ever sales volume, sales value, collection and handovers. Also highest ever revenue, EBITDA and net profit. I wish to say that it has been a good year for us and we remain optimistic about our future. The mid-market and mid-premium segments are gaining significant momentum and overall market trends are very, very positive. Coupled with our robust operating platform and strong pipeline of projects, we are very well positioned to capitalize on the industry's ongoing consolidation. I would like now ask Gopal to briefly discuss the performance in detail with you. I'll be happy to answer any questions you might have thereafter.
Thank you, sir. Good morning, everyone. My name is Gopal, and over the next 30 minutes, I'll walk you through our operational and financial performance for the full year and the quarter. As Mr. Murali mentioned, the quarter has been excellent. More importantly, the year has been one of the best years that Shriram has seen in recent years. So it's a record high performance on almost key parameters. For the year, we ended with 4.59 million square feet of sales volume, reflecting a growth of 14% year on year, with a sales value of 2,362 crores, reflecting a growth of 28% year on year. Record high collections of 1,390 crores, reflecting a growth of 16% year on year. Total handover of a record high number of 3,000 plus homes or plots, which reflects a growth of 50% year on year. I must say, these are all reflected in the presentation which is uploaded on the website of the company as well as stock exchanges. I assume you are referring to those presentations and have access to it, and therefore I'm going to refer these slide numbers in the presentation. We are at slide number 4, and that's where the full year KPIs are highlighted. On a Q4 basis, more precisely for some of you who are looking for a quarterly data, 1.56 million square feet of sales volume, up 19% year on year. 708 crores of sales value, up 43% year on year. 336 crores of collection, reflecting a growth of 10% year on year. And 1,400 homes got handed over, reflecting growth of 84% year on year. More importantly, out of 3,000 homes we delivered, as you may recall from the previous conference calls, we had some delays in receipt of OC in the month of December, and we received them towards the end of the quarter, and some of them in January. And therefore, effectively in less than 60 days, the team has delivered 1,400 handovers for the quarter, which not only is a satisfactory moment for us, but it also reinforces the system capability. And that gives more confidence to the management, saying that system is now more capable of handling larger scale and size. in our operation, and therefore we are equipped to handle much larger volumes in the coming years. Slide number 5 primarily captures this number in a trend basis. On a sales volume, we have reported about 15% CAGR over the last 3 years. On a sales value basis, 24% CAGR. Collection 15% higher on an average basis, and handovers have grown 42% on an average basis over the last 3 years. Shifting focus on key highlights for the year. As I emphasized already, several KPIs at a new high. This is slide number 6. Several KPIs at a new high, be it sales volume, sales value, collections or handovers. Up 14% year on year for the full year. Value is up 28%, collection 16% growth, despite all the delayed launches that we had and the record handovers that I spoke a few minutes ago. More important, on the execution side, 3 projects received OC in Q4 ahead of radar timelines, and overall 8 projects moved to completed portfolio, aggregating to about 3.8 million square feet of developed area. Delivering completing 4 million square feet on an annual basis for the second consecutive year. Again, endorses our system capability on the ramp-up capability that we have achieved, and it is gives us a confidence on delivering 4 million plus kind of volumes annually over the next couple of years. Our construction momentum has regained further momentum, with activities shifting away from the completion and OC focus in the last quarter to a ramp up in construction in ongoing projects during this quarter. As well as we have commenced work on some of the new projects. All of this should actually accelerate construction spending in the coming years. Shifting to financial performance on the same slide, we had a record high revenue, near 1,000 crore revenue mark. We just missed the 1,000 crore mark by I think about 10 crore, 13 crore number. Remarkable growth in handover was behind this strong growth in revenue recognition. EBITDA is up 22% year on year, PBT is up about 7%, PAT is up by about 10% to 75.4 crores. All of them are record high numbers for Shriram. More important is the stability in operating margins. We've had a very stable EBITDA margin, PBT margin and PAT margins even during this year. Across the quarter we saw, but it's very satisfying to see on an annual basis we are stabilizing our profitability, which actually is confirms that we are on the right path to delivering much larger scale and volume and profitability in future. Cash from operations, which is very relevant in this business. Cash from operations have doubled, almost doubled to 224 crores in this year. And you would see in the subsequent slide that free cash flow has been very encouraging as well. Against an expectation of 350-400 crores of free cash flow, we have already delivered, recognized or realized more than 270 crores of free cash flow between last year and this year, which is a very satisfying progress for us. While we are looking forward to pushing ourselves more harder, but I think it's a very satisfying moment to know that the numbers are on track. Interest cost is flat. However, due to some one-time costs that I'll explain in Q2 and Q3, due to project acquisition related costs, our overall finance cost is up about 11%. We expect that to drop further in FY25. Even interest costs should go down in FY25. Cost of debt is stabilizing at 0.5%, and incremental borrowing is done at about 10% levels, and that's therefore a satisfying moment for us. Our debt equity at 0.34 remains one of the lowest in the sector, and we see it dropping further in FY25. On the business development and the growth initiatives, I think Pune market entry is the most important landmark. We're hoping to do it in Q4. I think the regulatory approvals have got pushed due to code of conduct and others. We got pushed to this quarter. We are looking to make a successful entry into Pune in Q1 FY25. Project pipeline is strong enough to support the growth momentum. We will discuss that in subsequent slides. We'll discuss about the Kolkata part. Logos deal is, as I explained in the last conference call, it's strategically delayed or pushed to current year because we are trying to solve a 4% royalty issue more proactively. And once the code of conduct issues are sorted out, I think we should be able to make meaningful progress towards closure. And subsequently, we'll consummate the logos and the new launches in Kolkata. I'll explain that in detail if required. You may recall that we had thought about monetizing our mall assets, retail mall, approved mall land, approved mall project in Chennai land. And that monetization process has progressed well. We should be consummating or closing the transaction sometime during this quarter or early next. That's a good progress, and it should give us a cash flows in FY25. Shifting attention to little finer aspects of individual KPIs. Slide number 7 talks about our launch and sales performance. 6 launches, majority of them did well. Shubham in Chennai got launched towards last week of March. Therefore, they've sold only about 4-5% of the project area because it was only 1 week operation. 122 West is a project which took off meaningfully, but then momentum slowed down. So we are reviving or relaunching that project, and that had a 7% sales in the last quarter. But for these two, I think all others are in a attractive zone from a sales at launch perspective. The most important was the Sapphire launch, a project called Shriram Sapphire in Bangalore. It was launched with the code name of Ultimate, slide number 8. Received a very good response. We sold about 70% in the first week. As of within 1 month of launch, we did about 80% of the project inventory got sold. That gives us a confidence and a new visibility or new insight on moving up the sales at launch curve with the changing market dynamics. But overall, I think the sales side is delivering well. That's a limited point I wanted to deliver. I want to submit to you all. From the market perspective, I think the market trend is strong. All of you know better, and therefore I didn't really cover the market slide, which are in annexes to the website presentation. But the pricing trend has been reasonably encouraging. As a market average, publicly available research reports tell us that Bangalore price have moved up by about 8 to 9%. Chennai moved up by about 5%. Compared to this, our core market price increases. Our portfolio level price increases have been much more encouraging, about 12% higher price compared to what we did in our portfolio projects last year, on top of an 8% increase in FY23. Therefore, that gives us a comfort that the market undercurrent remains strong, and we should be able to capitalize on it in the next 12 to 24 months, even more strongly than what we did in the last 2 years. More importantly, as we have always been emphasizing, we have been consciously trying to move up the price curve or the value curve, because we used to be at a larger discount or a peer group, and that gap is getting narrowed. As you could see from the chart on the slide 9, right-hand side bottom, mid-market products which we used to sell below 5,000 rupees pre-COVID is now getting sold at about 6,300 rupees per square feet. That is an encouraging upward movement for us. One, the market improvement is reflective here, as well as our conscious effort to upgrade the portfolio in terms of micro-market selection or the product configuration that help us in realizing that extra 100 rupees per square feet type kind of price increases from time to time. So we're very comfortable, confident on being on a positive side of the price curve over the next at least 12 to 24 months, and therefore we see a conducive operating environment. The third dimension to our KPI was the handovers and delivery, and some of the projects that we got delivered during the year is highlighted in slide 10. I've already said that we have delivered 3,000 homes and 1,400 homes in the last 50-60 days alone. Interestingly, there's a small picture on the slide 10 which shows how aggressively our handover and completions and handover ramp up has happened over the last 5-6 years. Some of you or several of you had this question about capability. I think over the last 3 years, we have demonstrated our ramp-up capability, both in terms of sales volumes as well as in completion and handover. And this image, moving from 700 homes handed over in FY 19-20 to about 3,000 homes, speaks volumes about the system capability that we have built. which is very encouraging, keeping in mind the aggressive growth that we are trying to pursue over the next 3 years. Shifting attention to financial performance, slide number 12. It is satisfying to note that this is our 10th quarter of sustained profitability and earnings since the initial turnaround post-IPO in December 21. That's an encouraging moment to start with, and to encouraged by the fact that we've had for the full year, we've had an highest revenue, EBITDA. Record high revenue recognition was supported by the handovers, as you know. But the profitability metrics have been encouraging. EBITDA is up 22%, PBT is about 7%, net profit is at about 75 crores, which is a new high for us. More importantly, as I said, margins have stabilized in the mid-20s at EBITDA level, mid-30s in the gross margin level, and 10% in the PBT level. ROC is at about 11% plus. We remain confident and seem on track to deliver a mid-teen ROC for the next 2 years, as we have been consistently talking about. Several value-accretive transactions happened during this year. Acquisition of a DM project into our company as Shriram 122 West, and we launching that late last year, and transferring that project into ASK co-investment platform was a big value-accretive move on our part as a company. Reacquisition of JV interest from Mitsubishi Corporation in our project, ongoing or nearing completion project called Shriram Park 63 is another value-accretive move which we managed to consummate successfully. Gateway Mall monetization progressed well, reached near closure. We wish we had closed this in March, then we could have got income recognition and profit recognition in the year. To that extent, we had a deferred income and profitability from this mall got deferred to FY25 instead of 24. This would have added revenue and profitability to the company. But be assured, this income has been now more certain. It's a question of documentation completion and consummation. The board has reviewed that yesterday, and therefore we are now fully prepared to consummate the transaction in the coming months. On the debt side, I will explain that in subsequent slide, but it's an encouraging progress for us so far. Slide 13, exactly the same point that I mentioned, captured in a graphical form, so I'll kind of skip that. Slide 14 is the critical page, explains our financial performance. Slide 15 gives you the explanation to it, but I will try to highlight some of the key points. Focusing on slide 14 on the financials, you would appreciate record high revenues, 21% year-on-year growth at near 1,000 crore revenue base, driven by OC and registrations and record high handovers during the year, more specifically in Q4. 75% of revenues were driven by recently completed projects. Liberty Square, Shriram Liberty Square, Shriram Chappingwood, Shriram Grand One in Kolkata, Shriram Park 63 and Shriram Sankari. These projects continue to contribute. Some of the new projects that came in Q4 were Shriram Liberty Square, Chappingwood Tower 5 and Grand One. They added big volumes to Q4 numbers, handovers and revenue recognition. That's encouraging. DMC momentum is a bit slow in Q4 as well as the full year. Accounted for only 7% of revenues. 3 projects drove it. But because of the completion of several DM projects during the year, plotted development or otherwise, the share of DM fees slowed down a little bit. We expect it to regain momentum because we have 3 DM projects coming up with full force in the coming year, and therefore we should regain the DM share in the current financial year. Cost of revenues up 77% year on year, which is in line with the increase in revenues, and therefore we remain comfortable on it. Gross margins have remained stable. In fact, it has inched up by a percentage to 34% from 33% last year at the gross margin level. EBITDA margins were slightly marginally higher, a tick up from 22 point something to 23%, and EBITDA year on year. healthy margin profile, minimal volatility on annual basis. These reflect the benefits of improving scale and business model maturity. I have always emphasized that our volatility or our margin profile was slightly different from industry averages 3-4 years ago, primarily because we were operating and handing over completion handover at a 1 million square feet annual scale, while we were selling at 3 million scale. As you know, real estate business is all about all costs are today, all revenues are 3 years down the line when you complete and hand over. And therefore, 1 million square feet revenue bay recognition and 3 million square feet run rate of expense recognition, that is why we had a margin stress. We were confident in 3 years ago when we did the road shows. Since then, we have consistently been telling people that this margin profile will improve with improving economies of scale and business model maturity, both in DM side as well as our own scale from 1-2 million square feet to 3-4 million square feet. I think those results are showing up, and therefore we remain confident of maintaining gross margin in the mid-30s, EBITDA margin in the mid-20s, and the PBT in the 9, 10, 11% range. Overall finance cost, as I said earlier, interest remains flat, but due to the non-cash charge as well as certain one-time costs, overall finance costs were up 11% during this year. As we have said in the previous calls, our one-time costs were primarily related to acquisition of Shriram 122 West from a DM partner, where the project came along with associated debt, which we carried in our books for more than a quarter, and then transferred that project when we vested the project to in a co-investment platform with ASK. We redeemed the debt, and therefore the costs were reflective in our books for that 1.5 quarters, and that's one-time cost for us. We also had an additional burden from Mitsubishi buyback, where the debt, Mitsubishi was to be paid in 3 tranches. We have paid 2 tranches already, and towards preparing ourselves for this and assumption of the remaining outstanding debt, these debts moved from joint venture to our books, and therefore interest was being incurred, which will continue till December 24. But these two were the non-routine costs. As a result, the finance cost went up by 11%. Profit before share of JV losses were about 96 crores, up 40% year on year. Share of JV income were negative. As you know, the JVs are still in the construction phase and they have not yet reached the revenue recognition. Therefore, as I said a few minutes ago, all costs are being recognized at the JV, and therefore we are picking up our share of cost in the JV. 3 JVs are in apartment construction mode. Shriram Greenfield is almost complete. Shriram 107 West and Shriram Whitefield is a project. These 2 projects will reach revenue recognition in the next 12 to 24 months. Until such time, we will be picking up a share of marketing and other costs. The other cost which came from was the Prestige Estate, which is a joint venture, and those marketing costs and 122 West launch expenses were all the costs that led the JV share of losses higher this year, which is launch-related costs. And despite this higher JV share of negative income, our profits were at about 75.4 crores compared to 68 crore last year, and the earnings per share remains very healthy at 4.4 crores when compared with the minuscule positive earnings we used to have 12 to 18 months ago. Shifting attention on the balance sheet side, I think the balance sheet remains healthy. Slide number 17. We have one of the highest ROCs in the listed space now. Prestige and Brigade have higher than us ROC at 12% and 14%. But rest of the sector still has a lower ROC and several of them at a single digit ROC. We moving up from a 4% ROC in FY 19-20 to a 11% ROC gives the comfort that some of the strategies that we are working towards is paying off, and we'll continue to work towards it. And as I said at the beginning of the session, we will work towards reaching a mid-teen ROC in the next 12 to 18 months time. More important slide number 18, cash flows. As I said, very positive and encouraging cash flow outlook. Cash flow from operation nearly doubled in FY24. We had 227 crores of cash flows up from operations compared to 115 crore in the previous year. And net of all the repayment, financing and borrowing related activities, free cash flow from free cash flow before new project investments remained healthy at 156 crores compared to 116 crore last year. More important, we have now realized unlocked 270 crores of cash flows, free cash flow from operation in the last 2 years. As some of you may be recollecting, we've always been saying 350-400 crores of cash will come from projects over the next couple of years. And it's encouraging to see that we have covered a large part of this ground in the last 2 years, with a few monetization coming up, with a few more projects coming up to closure this year with handover targets. We believe we will definitely achieve the 350 odd crores of cash flows, or maybe surpass that number over the next 12 to 18 months in terms of unlocking free cash flow. This will help us to rebuild our growth pipeline by redeploying this capital and without stressing the balance sheet beyond a point. We should be able to grow the pipeline and sustain our growth momentum for the next 3-4 years. And therefore, this is an encouraging development for us. Next slide talks about the debt profile, which we have discussed multiple times in the past. Cost of debt has been coming down, slide 19. Bank share remains healthy at about 41. We are now focusing on banks further to improve their share beyond 50, 55, 60% levels, so that our cost of debt can drop even further from the current levels. Incremental borrowings are being done at about 10 odd %. That gives us the comfort that the cost of borrowing could come down from the current levels, though may not be as dramatic as what we have seen over the last 3 years. So that's fundamentally about FY. Spend a couple of minutes on FY25 and then I'll stop for taking questions. Looking at slide 21, our overall strategic objective remains unchanged. 20% plus kind of CAGR we want to ensure in our sales side. We want to ensure our sustained profitability and improving returns. We will continue to work towards zero net debt. We will have gross debt at all times. We will work towards having a zero net debt over the next 12 to 18 months time. FY25 context is built within this strategic objective. The market conditions are favorable, so I think FY25 context is more encouraging for us. Operating platform has remained proved robust, has withstood the test of time through the NBFC crisis, COVID, post-COVID challenges. All of this we have put the system through, and both sales side, construction side, CRM side, and the support side in terms of finance, legal, and others have all rose up to the occasions and have proved robust and resilient. And that gives us the confidence that we should pursue more aggressive growth. Keeping that in mind, we have set ourselves a target of 5.2 to 5.5 million square feet of sales volume, which reflects a 20% growth from current levels at the higher end. Sales value will grow by about 27% to between 2,750 crores to 3,000 crores in a range. Collection should be in the 1,700 to 1,800 crore range. Handover should be somewhere around 3,300 to 3,500 homes to be handed over. It should reflect about 17-18% growth as we go through. Slide 22 captures the same thing on a CAGR basis. Where do we get this comfort and confidence to give you this indication or guidance on our FY25? Slide 23 and 24 will tell you why we have this confidence. As we ended the year, from our ongoing project, as we have always said, 23 million square feet of ongoing portfolio. Of this, our share of sales would be somewhere around 22 million square feet. About 5 million square feet is the closing inventory that we had, which is the unsold portion of ongoing projects. we have zero inventory in sold completed projects. So roughly 5 million square feet of opening stock. We're adding another 6 million square feet of supply. Between these 11 million square feet, we are trying to sell about 5.2 to 5.5 million square feet. New launches should contribute to about 2.5 million square feet of sales for the first year. The rest will come from the sustenance sales in ongoing projects. These projects are nearly ready. If you look at the table there, the launch readiness of each of the projects is there, except for projects that are meant for Q4, where the plan approval and in one case, even the acquisition process is under closure. But otherwise, the projects are all under control. Development rights are with us. In several of them, plan approval is there, or they are at the last stage of approval. And therefore, we have good comfort in launches during these timelines, Q1, Q2, Q3, Q4, as we have highlighted here. We'll track them and report to you on a quarterly basis. On the completion and handover, which is very critical for our revenue recognition in FY25, slide 24 gives you the snapshot. Out of 3,500 homes that we are targeting to deliver, 2,700 homes will come from these 7-8 projects. Rest will come from the projects that have been completed and OC received last financial year, and some of them may not have completed the handover and registrations, and therefore the balance will come from there. But majority of it, 2,700 out of 3,500, comes from these 7-8 projects. They're all in an advanced stage of complete finishing work, except for 1 or 2 projects which are meant for handover towards the end of next year. And therefore, we will focus attention on completing those projects, Prestige and Mystique. Remaining projects are at a very advanced stage, even as we entered the financial year, and therefore we are confident of delivery ahead of timeline in most cases, ahead of RERA timeline or customer committed timelines in most cases. Slides 25 and 26 give you a snapshot of where these projects are, a pictorial representation of their progress. Slide 27 gives you a snapshot, and it was aimed at giving you comfort on the fact that it is not just about FY24 record high year and so on. We have a very good visibility on our earnings outlook for the next 3 years, not just FY25. As I said, in real estate business, all costs are today, all revenue recognition is 3 years from the day when you sell, when you complete the project and handover. Therefore, based on the sales we have made, we have a reasonable visibility on what the current status of these projects. Combining these two, we have a good visibility on where the handover outlook or revenue recognition outlook for the next 3 years is. We are very confident of sustaining a growth momentum, both in terms of 3,500 units to be handed over in FY25, as well as a target of roughly 10,000 homes to be delivered over the next 3 years, 25, 26, and 27. More importantly, a large part of these handovers are already sold as of March 31st, 2024. And therefore, the earnings certainty is high. As long as we execute and deliver these units, we should be able to recognize these revenues. Last slide for me, project pipeline. As you recall, we have certain projects which are still work in progress, certain projects where there are land acquisition or last mile acquisitions are work in progress. So 8 million square feet were kept as deferred. For convenience sake or consistency sake, we have kept them outside the comparison for now. And as you can see in the footnote in that slide 28, 8.odd million square feet is not shown in this slide. Even excluding that, all the reasonably certain projects or projects under good control is aggregating to 42 million square feet of ready pipeline or the live pipeline, 24 million ongoing, 18-19 million square feet is ready for at various stages of preparedness for launch. They should support our proposed growth path starting with 5.5 million square feet in FY25 and ramping up further over the next subsequent 2 years. we'll at an appropriate time discuss about our 3-year outlook, maybe when you have a call next time or when you have an analyst meet soon. So overall, is a company which is scaled up nicely from a less than 1 million square feet pre-RERA to a 4.5 million square feet over the last couple of years annually. A lot of you had concerns around scalability. I think we have demonstrated our scalability right now. Some of the other concerns are profitability. Over the last 3 years, at least post-listing, I think third financial year now, we have demonstrated our ability to sustain profitable profit margins with a less volatility, notwithstanding all the market-related volatilities. We have been able to demonstrate our ability to keep the margins in the mid-20s, the EBITDA level, and PBT, PAT in the 9-10% range. We believe, based on the profile of the portfolio that we are progressing right now, we should be able to sustain this margin and maybe improve slightly. Third, the system has demonstrated its capability to deliver consistently on execution as well as sales marketing. And that gives us, all of these are right ingredients that should take us to a much larger scale from this 5 million square feet that we have set as a target, 5.5 million square feet target that we have set. We should be able to go to a newer, greater benchmarks in the next 2 years. So we are looking at an ambitious growth path between FY25 and FY27. We look forward to meeting our targets and delivering sustained profitability and improving returns to our shareholders going forward. The rest of the slides are available in your pack for reference at your leisure. And last but not the least, slide 31 message. Some of you had always been asking us about the shareholding changes and all that. Shareholding profile is shown in slide 31. Promoters own 28%, consistently owning that number. Will remain there. The interstate promoter may go through some restructuring between the ownership share, interstate being changed between Mr. Murli, who is the chairman and owns a part of this promoter whole group, and the Shriram group. We are still working towards it. As and when it is finalized, formed up, respective boards will make it, will come back to you. But we would like to clarify, the promoter holding will remain 28%, will not change from these numbers downwards. And therefore, just wanted to remove the concern from people's mind on any potential changes. With that, I will stop, and Mr. Murli, myself, and the rest of my colleagues who are in this room will be very happy to answer questions that you may have. Thank you for patient hearing, and look forward to answering your queries.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Narendra from Robo Capital. Please go ahead.
Hi, sir. Congratulations on a good set of numbers. So my first question is, what would be the reported revenues in FY25 and 26, and also the EBITDA margins?
Difficult for me to comment on revenue number, but we would hand over close to 3,500 homes. A similar growth should be visible in the revenue. I would prefer to stay away from a revenue guidance. EBITDA margins will remain in the same range. Mid-20s range will continue. Maybe I'll try and answer your question in another way. On an average, our ticket size is about 6,000 rupees per square feet, and 1,300, 1,400 square feet is the average unit size. 1,200 square feet. So if you work backwards, we should see a meaningful growth in revenue from the reported number. So I'll leave that revenue at that stage. But EBITDA margin, I can assure you that we would be EBITDA and PBT PAT margin should be in the similar range, mid-20s and about 9 to 10% PAT, which will be very consistent with what the rest of the industry is doing from the resi side.
Sir, what did you say was your average price?
Currently, the mid-market is about 6,000 rupees, 6,300 rupees is the ticket size. As I showed in the presentation, our mid-market, the affordable product should be slightly lower from a ticket size perspective. Put a basket as a whole, we should have at least 5,500 rupees would be a average basket size for the revenue recognition.
Okay, great. And on the delivery side, so you said that 10,000 you want to deliver over a period of 3 years, right? So this 3,500 kind of rate we should expect every year over the next 3 years?
Yeah, should rise actually.
Okay.
Should grow.
So that 10,000 number is a conservative number, right? Because if we say 3,500 and it could rise further, so that brings us to more than 10,000.
Sure.
Okay. Thank you so much.
Thank you. The next question is from the line of Yash Dharvi from Systematic Share and Stock. Please go ahead.
Yeah.
Yeah, hi.
Yeah, hi sir, good morning. Congratulations on good set of results. Regarding the approved mall project in Chennai, so can you please explain the deal and what would be the expected cash flows from it?
Yeah, as you are probably aware, we had this large land parcel that we acquired from what was erstwhile known as Standard Motors car factory, and in Chennai. We converted that into a large integrated complex. Commercial space is done and sold to Xander. In fact, we sold it and we did a DM for commercial area. And Resi is called Park 63, which we are developing jointly with Mitsubishi and which we are buying back from Mitsubishi now. After developing these two, there is another piece of land within the same complex. There is another area or parcel which is which is approved for retail mall development. And since that is not our core business, we prefer to monetize the FSI, and therefore we have been in negotiation or we have been looking around. We have identified a potential buyer, reasonably credible, reasonably large and credible existing mall operator. And we are at an advanced stage of closure. Yesterday the board has reviewed and supported the transaction that is being done. And we should be able to consummate the transaction once. Well, there's only one modification. Currently is already approved for a mall. So, but the proposed buyer has a different configuration for the mall in mind. So the plan needs to be modified before we can consummate and realize cash flows. We expect to consummate the transaction subject to, because it involves approval from the planning authorities in the local market, that is CMDA. I'm not able to commit a timeline on the approval CP, but based on our experience, we believe it should take between 3 to 6 months max. I'm just very conservatively putting with all the election and uncertainties in mind. So during this year, we should be able to realize the cash flows. And till the deal is announced, I would prefer to stay away from the cash flow quantification. But it will be a very large number considering our annual current cash flows that we do. It's a material number. I prefer to stay away because we haven't disclosed this number that transaction is still not publicly disclosed, and therefore I would like to stay away from the cash flow number. But be assured it is a meaningfully relative to the annual cash flow that we generate now. It is a significant number.
Okay, sir. And just to follow up on that, so would this be used for a debt reduction as well?
You'll see, obviously you can either use it for debt reduction or you can grow. A combination of both is our objective, because as you see it, rest of the market is overall market conditions are very robust. Rest of our peer group is growing faster, and you may have seen the publicly available research on CRISIL or others showing our national market share as well as South Indian market share has moved up nicely. But we expect that we would like to have a much larger share in our core market, even though we are among top 3 and top 5 in each of our markets, but we still like to have a higher market share. For that, we need a growth, we need pipeline. So a combination of growth investment as well as new project acquisition investment as well as debt reduction will be considered. Our debt equity is already low, without considering any acquisition or divestment, without considering any divestment cash flow, the FSI monetization cash flows. Based on our core operations alone, our debt equity should drop to about 0.25, 0.28 in FY25, end of 25. With that kind of debt profile, if you go on reducing only debt as a deployment of your cash flows, growth will get hampered. So it has to be a balanced approach.
Okay, sir, got it. And my next question would be regarding the relaunch of 122 West. So how has been the current feedback regarding the project, and what reworking have we done it? And when can we expect the relaunch?
I must correct myself. I've used the wrong word. It's not a relaunch. It's a continuous marketing strategy that we need to roll out. It has to be a repositioning of that product. So we are already working on it. The campaigns like Book Now, Pay Later, those kind of schemes that get rolled out from time to time to trigger walk-ins and closing. We are already on path to execute that strategy. Chennai market went through a little bit of a lull over the last 3-4 months, flooding and all that. I think markets are back to routine now. Therefore, we think first 6 months, Q1 and Q2 should give us a meaningful traction on this project. So it's not a relaunch in that sense. It's already launched. We keep opening new phases, new blocks. Those are all, if I can very loosely call it, marketing gimmicks or marketing strategy.
Okay, sir, got it. And the last question regarding the logos deal. So any expected cash flows from the project, if you could give an answer.
As I said earlier, and I promised to clarify more in the Q&A session, I'll explain that. So as we explained in our last earnings call, we are in the process of negotiating or closing out the outstanding differences between us and Government of West Bengal on this 4% royalty issue. And the focus currently is on solving that, because as I explained at length in the previous earnings call, it's a 256 crore royalty burden that we are carrying in our books. We are every quarter or every year, as you see in our P&L, 20 crore non-cash charge, which is nothing but an unwinding effect of that provision, is going up into interest charges. We want to prevent all of this. I think we have reached a closure. Unfortunately, the code of conduct kicked in before we could consummate all of the negotiations into a proper action. So we are expecting to regain the momentum in this process in the next couple of weeks when the code of conduct disappears. So once that is over, I think then the consummation of logos will also be through, as well as launching new phases and new products in our integrated township, be it plotted development or villa development. All of this will get launched. As you would have seen in the slide, some of the products that we are targeted for this year includes Kolkata. So all of this will get cleared and accelerated very quickly. So we are looking to solve this during first half.
Okay, sir, that was helpful. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Dixit Doshi from Whitestone Financial Advisors Private Limited. Please go ahead.
Thanks for the opportunity. So my first question is, in the Q4, we have hand over around 1,400 units. So, roughly how much square feet it would have been?
It would be about 1.5 million square feet, 1.8 million square feet. I don't have the number right now. My colleague is pulling it out. About 1.5 to 1.8 million square feet.
Okay, 1.5 to 1.8 million square feet. So that so our revenue was around 302 crore if I exclude the other income. So then the realization is hardly around 2,000 rupees a square feet.
So some of the handovers would be in joint ventures, right? It will not show up here because Shriram Greenfield got 600 units got handed over. That will come as part of a joint venture, and joint venture is masked by other joint venture losses. So so you would not see that may not be the right metric. But you made a very interesting comment. So I want to clarify for everybody's benefit. Removing other income was a comment that you made.
Yeah.
So I wish to clarify, this may be a question in people's mind as well, other participants' mind as well. Unlike manufacturing or other companies, our other income is not isolated, non-operating related, because there are several transactions which under the accounting standard will have to be classified as other income, and therefore our other income has three components. That's why they remain reasonably meaningful when you compare the overall P&L. Our other income has an interest component coming from interest from JV loans to JVs or others we have given. Our own joint ventures, right? Intercompany loans that we give because they are all registered independent projects. Second component would be the income that we realize from our joint venture in terms of their valuation. So we would have transferred these projects to the joint venture like ASK at a particular price point as a valuation. So there is a fair value gain which you get on these investments. That would be a large component. If I add these two alone in FY24, just for FY24, 92 crores out of
23.
92 crore out of 123 crore would be from joint venture income as well as interest income on loans given by Shriram. Only the balance is the true other income component. So if somebody excludes this from an EBITDA calculation, to that extent they will be misleading or misunderstanding the EBITDA margin in my limited view. What we will try and do is in future from Q1 onwards, we'll try to segregate other operating income and true other income in our representation in future. But for now, I just wanted to clarify. Since you mentioned excluding other income. Sorry.
Yeah. So I was actually coming to that second issue of other income. So, but what my question was related to, so obviously this 56 crore in the Q4, some of this will be interest from JV or a fair value change for some projects. But when we look at the 302 crore, where actually the revenue recognition of handover project, then the margins in the handover project is not that great. So my question was related to that.
Yeah, some of them would be because, for example, projects like Grand 1, which is in Kolkata, has suffered for 7 years. So they would now they will come for margin revenue recognition. So 6-year, 5-year delay in approvals, all of this. So some of them are low margin products. That's a legacy that we are going through. But we have not much legacy projects left in our portfolio now because except for Vizag and Kolkata, rest of the projects are fairly new, post-RERA, recent time projects. So these two, until we complete revenue recognition in Grand 1 to be precise, the Sunshine, which is the second phase of Bengal, is a current project. Grand 1 has absorbed a lot of historical burden on it. So to that extent, therefore, there will be a stress on the overall margin. My colleague points out that there's one more project he wants to point out is a Shankari, which is a Chennai project, which was partly completed long ago, and it has taken much longer to complete now the last phase. last but one phase. So these three projects have dragged overall margin profile, and those legacies will have to be cleaned up. It will take some time. So maybe this will continue this year and next year. I mean, like FY24 and 25, these will be out as well.
Because, so my question was related to that, because if I remove the other income, which is, not related to the delivered project, obviously those other income was also operational income, but they are not related to the projects which are handed over. So if I remove that 56 crore, then our PBT is actually negative, which is 32 crore even before the JV share. So does that mean that, the projects which we have handed over, we have actually not made money?
No, that's not right way to know. It is like saying Hindustan Lever, one particular brand of toothpaste, how much is making, and it has to absorb all the cost of the company. That's not right, no? You can't dissect like that. It's a portfolio, right?
No, let's say in Q3,
margin, my friend, you have to see the gross margin. You cannot say all entire PBT level one quarter only a particular component of your operation cannot sustain.
Okay. So gross margin, you are saying that we will be able to sustain 30.
It will have a single-digit gross margin. I must tell you, I must admit, candidly admit, that legacy projects would have a single-digit or a very low double-digit gross margin.
Okay.
That's what I meant to stress.
Okay.
The gross margin, right, which is nothing but revenue from operation minus cost of revenue.
Okay.
Right? That should be a single-digit or a low double-digit. We don't want to be more than that because they have carried the burden for a long. And every portfolio will have some burden, right? Any developer you look at, right? Otherwise, why would some of these guys have a margin profile which what you have seen in the last 4, 5 weeks? There must be some stress in some projects, right? That will always be. You have to see, if you are seeing a PBT level, you should see it holistically. Even EBITDA level, you should see holistically because the employee costs, other expenses includes all the marketing costs, right? How can one project upset all of that?
Yeah. Understood. And in terms of JV, how much revenue would have been recognized? Because just to understand, so out of this 1.5 million square feet, which we must have handed over, how much would have been in the JV?
JV, volume-wise, I can tell you, my colleagues are looking for the revenue number. Volume-wise, about 600 in the full year, 550. 550 would be a full year basis, 550 out of 3,000. And in Q4, almost the entire 550 out of 1,400 would be in the joint venture, which is Shriram Greenfield was handed over and recognized. They are looking for the revenue data. I can share with you through Rahul or SGA. We will share this number with you.
Okay. Now, my last question on the slide where you have mentioned the FY25 project delivery. So you mentioned that our average ticket size would be 1,000 square feet with 5,000, 6,000 rupees a realization. So how much would be realization in the plots? Because for next year, a lot of deliveries are planned on a plots also.
Three plot companies, yes, I agree with you. Plots would be like, let me go to the slide, let me just explain. Slide 24, right? So, Prestige Estate is selling at around 4,000 rupees per square feet plot. Surfing Ridge is a DM project, so it will not come in our books as an income, it will come only DMC will come. Westwood is also a plot which is a DM project, so therefore only the DM revenue will come to us. But for indication, Surfing Ridge is selling at around 2,700, 2,600. Westwood is getting sold somewhere around 2,000 rupees per square feet.
Okay.
But our P&L will show only Prestige Estate as part of joint venture. That's a project under the ASK platform.
Okay. Okay. That's it from my side. Thanks.
Thank you. Insightful questions.
Thank you.